Well, on the markets and the impact of the potential rate rise on the company profits and also the economy, I spoke a little earlier with the Chief Executive of Australia's oldest listed investment company, AFIC, and that's Mark Freeman, the Australian Foundation Investment Company.
I think it'd be pretty tough on Australians to see another interest rate increase. Obviously, overseas markets, particularly the US, were way more aggressive than Australia were in putting up rates, and they went harder and higher. So it's probably not surprising that they're looking to lower them, and that's the expectation in the market, is the US will start cutting rates from higher levels. I would have thought we would probably be a bit more, I guess, wary at this point of putting rates up, but obviously we're going to get data out soon. But the inflation seems to be softening a little bit. Retailing's pretty tough. And so I guess we're a bit cautious about where our economy is heading at this point. So I think it would be pretty tough to see another rate increase.
Given the fact that you're a value investor and we've got shares right now close to all-time highs, yet you've got this very cautious outlook for Australia's economy into the future, does that suggest that our current market highs, where we've followed international markets, might be illusory compared with what's happening on the ground with our companies and their profits?
Yeah, sure. And we are cautious, and we do look to buy when we see value, but we do stick with quality companies as well. So, yeah, I guess when we look at some of the longer term indicators, if you look at price to sales or price to book, or even the PE of the Australian market and indeed the US, valuations are certainly elevated. And yeah, we're a bit surprised that the markets have been so strong. They reacted very positively to the prospect of interest rates being cut in the US rather than looking behind the reasons of that, which perhaps more is about a slowing economy. So we're a bit wary. We're happy to stick with quality companies. If things do get tougher, you want to be in good, strong businesses with good balance sheets. That suits us, but we're wary about putting new money into the market at these levels.
Is there a trend right now for investors such as you to try and seek companies that do have options where they invest their money? In other words, they're multinational companies, and more Australian companies these days do have those overseas operations where they could choose to invest in Europe or choose to invest more of their capital into the United States. Is that something that really Australia as a government, as a nation, that we've got to be cautious of, that other places may actually offer more attractiveness for local capital?
Oh, absolutely, 100%, because if you look at the success stories in our portfolio, and increasingly more money is going into successful global businesses. You go through the list of businesses like James Hardie, Macquarie, CSL, ResMed, more recently tech stocks like WiseTech. The list goes on and on and on. Now, these are great companies, and ultimately share markets and share prices follow profits. So if that's where you're making profits, that's where you tend to look at. I think the other thing that supports the Australian companies, though, is the ability to pay franked dividends. And so we're very supportive of, or have been, of the banks. We were buying some of the Australian banks a year ago, but it's the franking credits that are attached to those that make the dividend yield really attractive. And so we still like that. So as long as the franking system stays in place, will means that Australian companies will be of interest to us as a longer term investor. But if that system left, that would make them quite unappealing. So, but at the margin, yeah, there's a lot of great Australian companies that are growing overseas, and we've been certainly adding those to the portfolio over time.
Go back to your point about the franking credits and that dividend system here in Australia with taxation. You know that there's been rumblings inside the government. You know there's been rumblings inside the Treasury about whether that system should be changed. Have you done any lobbying yourself to try and ensure that the system remains intact?
Yeah, look, we think it's a great system. It's a very clean system. It's unique. It avoids double taxation, which is really important, and makes Australian companies very attractive for people to invest in. And it's very interesting when you look at the downturns that we've had in markets over time. Often companies come back to the market, they want capital, and the ability to pay franked dividends makes them very appealing. So it makes the whole system of investing in Australia. It also helps support self-managed super. If you didn't have franking credits, I think there would be a lot of people saying, well, I'll just live off the government now. There's no point doing self-managed super. So there are so many benefits for the Australian markets. It makes it very appealing. So certainly if we act in the interest of our shareholders, if we feel that there's something happening to the system to change it, we will certainly stand up. We watch with interest. When the system came under review last time, we certainly were very strong in making a stand and supporting our shareholders. At this point in time, the system seems to be carrying on. It did become quite a big election issue last time, and so hopefully it's off the agenda and we can maintain what is a great system.
And just a final one for you, Mark. As a value investor long term, do you find it hard to keep up with index funds that may naturally have more tech in them, whereas your portfolio historically won't necessarily have a lot of tech in it because the profits are not proven, all that type of thing? Is that one issue where you may struggle to keep up with some of the index funds, at least in the short term, when things do go a little crazy as they have in the past 12 months?
Yeah, I don't think it does, because if you look at their frameworks we use for looking at investing in companies, they're the same frameworks you can apply to tech stocks. So great management, a form of competitive advantage, highly profitable, great growth prospects. We've been investing in a business like WiseTech, has all those attributes. The key to it is to to be early to the story, recognise what are the good companies and be willing to take a position. If they get overvalued, I mean, you can always trim a bit. We tend to ride the ups and downs more than not. Look, we've always got some stocks that are a little bit overvalued, but because we're running more of a diversified portfolio, that doesn't bother us too much. So, as I said, the key is to identify what are the good ones, the ones that actually generate real profits, that have strong market positions that you think are going to be around for the long term, and be willing to take positions in those companies.
I'll tell you what, Mark Freeman, always good to chat to you, and many thanks for your time today.